Hey, this is Brandon Steele. Welcome to the Mainsail Financial Group Podcast series, where we host industry experts and local professionals to really help share some guidance, some thoughts and tips into the areas that we don't necessarily get a focus on day to day. Today we want to thank Paul Cahill for joining us. He's a managing director and national sales for Virtus Investments, a boutique firm that manages about $150 billion in assets. And he himself has more than 23 years of experience in the financial services industry and has been a frequent speaker at industry events, really touching on all things behavioral finance. So given everything we've seen this year and going back to 2020, thought it'd be a really good chance to talk to Paul and kind of break apart how we can, utilize what we're all feeling emotionally to make sure that we're making sound investment choices.
The short answer, quite frankly, in the history of it all, and all of the studies show primarily that we're fairly poor decision maker when it comes to meeting our own financial goals, when it comes to making sound investment decisions. And that's really the genesis of behavioral finance.
Perfect. Okay. And really, I think what I've heard in there, what I kind of understand is a big part of that is how our emotions kind of affect those actions that we take in investing. So can you maybe just start there, talk broadly how some of that can carry into the actual actions that we make as investors?
Yeah. Well, emotions are at the very heart of it. I think that's the foundational part of this that you have to start with, that we as human beings are emotional decision makers, and you have to understand that. Because it's not really our ability to cognitively understand the right choices when it comes to finance. It's not that they're so complex. It's more about our lack of the emotional wherewithal to execute those actions that we know to be correct, to be more accurate during a highly emotional state, whether we're impacted positively or negatively, whether it's fear or greed. Each one of those extremes of the cycle are really what influence our short-term decision-making when it comes to finance. And it's really the area that is least effective when it comes to making those decisions. Some of the groundbreaking work that's been done here was by a gentleman named Daniel Kahneman and his partner Amos Tversky. Daniel Kahneman wrote a book earlier in 2000s called Thinking Fast and Slow. And it was just about how we make decisions when it comes to almost everything in life, but in particular when it comes to finance, and how it was dominated by our fear of loss, right? The idea that one of the most pronounced ways that we think is that we have an innate fear of loss. This is thousands of years of evolutionary history that have brought us to this place in time where we think a lot about loss, and we fear it almost twice as much measured in their studies than we do appreciate gains. So we're more fearful of losing money than we are positive or happy when we make money. So it causes us to kind of do the wrong thing at the wrong time for the wrong reasons when it comes to managing our own finances.
Huh, that's interesting. I've read that book actually, or I'm in progress of reading that book. Long one, but it's good. So the fear of loss. So obviously here we are, kind of heightened market. I don't necessarily want to get into the ins and outs of the market, but I'm curious, as we're kind of at this point, if that is like, is that the heaviest emotion that we recognize, and what, I guess, actions are typically taken in response to that, if that makes sense, what I'm trying to get to?
Well, it's one of many. I don't know how you weight it, and I think for everybody, it's going to be a little bit differently in their decision-making process, right? Emotions affect us most often at the extremes, both positive and negative in the markets. You think about last year, at the height of the fear of the pandemic in late February through early March, it really caused a stampede to safety in terms of our economic decision-making, what we did with our investments. And that was out of fear of the worsening of the pandemic. Well, what followed was one of the shortest recessions and shortest downturns of the market, or bear markets, that we've seen. And it actually was a really great time to have been investing in the market, not running away from it. But our own fears of the worsening of the pandemic. Logical, right? All completely logical and thoughtful, but it's an overly emotional decision that leads us down that path and causes us to make those decisions. And that's really where we see the emotions come in most, is at those extreme junctures. You go back to the credit crisis and you go back through history, there are always times where the worst results of it lead us to make the worst decisions, and really good times, right? So the euphoria of markets, you think about the tech bubble that we experienced in the late 90s and what Alan Greenspan had labeled as irrational exuberance. A great phrase, but it's pretty appropriate when it comes to the thought of behavioral finance, because it just leads us down that path. I would say it's a lot like thinking about dieting. If we were to put a bumper sticker on it and say, what's most important to do when it comes to dieting, you could simply say, eat less, exercise more. And that's the key. Really easy, simple instructions, something to stick to. But the problem with it is that it's very hard to execute. And the same thing with one of the oldest investment axioms that we use, which is buy low and sell high. We tend to do the exact opposite. In fact, it's been measured. There are studies going back called the Dalbar study, goes back more than 20 years now, where it shows the discrepancy between the return of an investment and the returns that an investor's actually achieved. And this, what they call a behavior gap, really always tends to show that investors left to their own devices really do the wrong thing at the wrong time for the wrong reasons. Not only do they underperform the very benchmarks they track, but they underperform their own investments based on the timing of those decisions. And so, to go back to your original question, I think fear of loss dominates that cycle and is one of the ones that you're most commonly going to see. But there are literally hundreds of biases that are documented in our thinking, in our evolutionary way of thinking, that we can point to and say that lead to different outcomes or poor decision making as it is.
Sure. Yeah, and I realize we're obviously not gonna get into every bias there, but
Sure.
But maybe a question that I have for you, now that you've brought up how many are out there, is how do we either overcome those biases or maybe it's not overcoming them, but being aware of them and managing through them?
It's funny, this is where I see one of the biggest weaknesses in the study of behavioral finance. We're really good at identifying them. We've done a great job. As I said earlier, there's hundreds that have been documented that studies show that we're all susceptible to in general. And the problem with that is that we're great at labeling them. We're not great at giving you ways to overcome them. There are some small tricks, and there's some things that we can do to make ourselves better decision makers. I think one of the things we do is simply what we're doing right now, engaging others, right? Overcoming biases is about, whereas the collective of us tends to be better than the individual decision maker. So looking for outside experts, looking for expert help when it comes to managing your finances, even if you yourself are a financial advisor, right? For me, I always recommend that people use an outside advisor, just as you would in any other profession. I always think about professional golfers or tennis players, and they pay a huge amount of their own income, substantial income that is, every year to people who can't possibly hit a ball or strike or sink a putt as well as they can. But they benefit from that outside, unemotional analysis of their well-being. Somebody to look at it from the outside, not in the moment, in the heat of the moment, but to give them instruction on ways that they can simply improve the outcomes based on shared goals. So having a plan, having a process around what you want to do. One of the things that we've found through time and the studies that we've looked at is that having a plan, always being able to anchor it back to what is your decision making based on? How do you have a plan about your financial well-being around an organized set of goals and what you look at in terms of the quality of those decisions. There's a new book out here, Adam Grant, who's a professor at Wharton, University of Pennsylvania. It's called Think Again. And he talks about how to overcome some of these biases. And one of the best lessons I learned from it was his talking about simply writing down a list of the conditions that would make you change your mind, no matter what it is, whether it's financial decision making or life choices, as it may be. But writing down the conditions which would make you change your mind about what your thoughts are on the markets, whether that's you think the markets are going to go way up or way down, or simply sideways, or you like one asset class over another asset class. What are the conditions that would make you change your mind? So having a plan, having a process, utilizing an outside expert, somebody who can give you an unemotional, unattached analysis of in this case, your financial well-being, your financial swing coach, if you will, I think really will help overcome some of these biases. But the truth is, we're not great at overcoming it. You're finding thousands of years of evolutionary history, and we're really not wired to do it very well. So it is certainly a easier problem to talk about than it is to change behavior. Again, we've identified this for many years now. We just haven't come up with a very good solution for how to fix it.
Sure. Okay. And obviously with everything we've seen last year and moving into this year, one side or the other, and this is not to talk about politics, but we have seen a lot of folks, asking questions based on politics,
Sure.
making market decisions based on politics. Can you talk a little bit about how, some of these studies affect our decisions based on political changes?
Yeah. Well, and two of the most common biases are anchoring bias, and the other is confirmation bias. And we live in a world today where information is abundant, it's cheap, and it's available at our fingers, right? The one thing that the internet has done is made information and data abundant. And anchoring and confirmation bias are fairly similar, right? One says that you seek out the information that simply confirms what you already believed. So whether that's your conservative political leanings, or you have very liberal, progressive political leanings, you seek out information that confirms what you already think. And you tend to dismiss that which contradicts it as wrong, as wrong-headed, and you see the great polarization we see in society. Well, this extends to you're thinking about markets and finances and other avenues of our lives. And then anchoring bias, you simply anchor your belief system to what you've already known or what is most widely available to you. So if you tend to be conservative, maybe you watch Fox News. If you tend to be liberal, you tend to maybe watch CNN, and you filter your own information so that it confirms what you're already thinking. And it spills over into all of our decision making, so that the other aspect is what's called illusory correlation, meaning we link together things that don't necessarily have a really high correlation. The fact of the matter is that who's in control of the White House and in control of Congress, you've seen very little distinction between the results when it comes to your investments or the stock market. Over the last 70, 80 years, it's been measured fairly closely, and there's very little distinction, and there's so many other elements that play into it. So that illusory correlation, the idea that athletes are guilty of this all the time, right? My lucky socks argument, right? That I only wear these lucky socks today, and that's the reason I had a great day at the ballpark or at the basketball court or whatever the case may be, and we're probably guilty of it in our own lives. And that's really the gist of where it comes down to when we talk about all of these things impacting us. And politics has just been one of the most divisive. And we probably link it to more things today because we have an abundance of information. And I think lastly, the one last comment I'd make about that is that when it comes to our decision making and looking at and filtering things through a political lens or a cultural lens, as it may be, we're linking things together that really don't belong or have much of an impact overall on what the financial outcomes are going to be. Whereas other factors may be more important that we might ignore if we weren't to look deeper beyond just the surface level of what a topic is, or simply dial everything back to a political leaning or ideology as it is.
Sure. Okay. Yep, that's good stuff. Since you kind of dug in a little bit on some specific biases, I know that this has nothing to do necessarily with the two you brought up, but can you talk a little about hindsight bias as well?
Yeah, hindsight or resulting bias, as is called, as well. The two are linked together. Basically, it says that we judge the quality of our decision making. We have a tendency to judge the quality of our decision making based on the results we achieve or what we see happen. And that we look back and say whether our decision-making process was flawed or it was good or bad. And we judge our decisions that way, right? Poker players are the ultimate example of that, because you have an unlimited amount of outcomes. When we're talking about finance, we're talking about investments, there is an unlimited set of outcomes that we're playing for. And to be able to judge the quality of our decision making, looking only in the rear view mirror, that can lead you to some really bad decisions. I'll give you an example. The example I always give when I'm talking to folks is if you left work this evening and on your way home you were rushing and you decided to run stop signs and red lights, you might make it home. And if you made it home at the end of that, you wouldn't look around and say, boy, what a great decision I made. This was a great outcome. You still made horrible, life-threatening decisions along the way to do that. And it could have had a really nasty impact on you if you had done things differently within a second's notice, right? You could have had dramatically different outcome. So your decision-making wasn't good simply because you had a good outcome in that case. My favorite example, and one you folks for yourself like this in Seattle may not like too much, is one that Pete Carroll made in the Super Bowl a couple of years ago against the New England Patriots. The decision to throw the ball from the 1 yard line. Looking back, he was roasted in terms of making an extremely poor decision. People said this was, I think the USA Today headline the next day was worst decision ever, which is not what you want to see in the newspaper the day after coaching the Super Bowl. And so when you dig deeper into that decision-making, though, and what he was thinking about on second down on the biggest play from the 1 yard line of the Super Bowl, he had a terrible outcome. Malcolm Butler intercepted the ball and changed the fortunes of the Seattle Seahawks, and they lost the Super Bowl because of that decision. But when you judge whether he made a good decision or a bad decision, you really have to unpack a lot more information to be fair to someone like Pete Carroll in that instance. And that is, how many other instances that year of people throwing the ball from the 1 yard line actually ended the way it did with an interception? The answer is none. There was nearly 70 attempts that year in the NFL. And in the previous 15 seasons, there was nearly 1,500 attempts to throw the ball from the 1 yard line like that. Nowhere near the incidence of an interception. You had less than a 1% ratio during that time period of that particular outcome. So in his mind, he had a really high probability of at least getting another play where he could have then handed the ball off. But looking back on it, history judges it as a really bad decision. But what I would say is he really had one of the unluckiest outcomes ever, not one of the poorest decisions. And that's something that we as human beings also have to do, is really learn to separate luck from good decision making. What's a sound decision that we make? And that goes back to my answer earlier about having a plan, writing down the conditions that force you to do something positive, something negative, to sell something or buy something when it comes to your individual financial choices. And I think that's really what it boils down to when we look at hindsight or resulting bias, and one of the dangerous things that we do. The other example I'd say for investors in the last several years, diversification is the greatest example. I'm yet to find anybody who would really argue me out of the concept of diversification, the idea that you don't put all of your investment eggs in one basket. That's a really sound, logical decision that most investors, almost all investors, would agree with. But when you have to live with the results, you look at the last couple of years, you look at the last decade since the credit crisis, and almost anything you did to diversify your portfolio actually worsened your investment results. They were worse than if you had simply taken the most risk, bought more equities in your portfolio. So just like my example of running the red lights, not diversifying over the last decade didn't make it a good decision just because you had a really good outcome. And those are where we tend to have the most trouble, the most difficulty making really good, sound decisions about our investment future and fortunes.
Sure. Okay, that's great. I'm going to go a little bit of a different path here, but I want to talk a little about, or ask you, I guess, how your cultural environment, how your kind of daily life, how some of those things impact your decisions as an investor as well.
Yeah, and I think it goes back to some of the stuff we talked about earlier. Culturally, when you grew up, the environment you grew up in, the time, right? I think you really see differences based on generational experiences, the culture. I think about my own teenage daughter. She was born in 2003, post the 9/11 era, grew up during the credit crisis, the school shooting era for her, now the pandemic, and all of the things that have impacted her foundation, her upbringing, and her generation will cause them to be different investors as they grow older. Maybe they'll be more risk averse. Maybe you'll see, like you did after the pandemic of 1918, that this young generation has almost a roaring 20s type of outcome to it, where they think life is to be lived at speed, right? That they see it as more precious and maybe more fleeting, and they tend to be more risk-taking or risk-averse. We just don't know how that'll play out. And I think culturally you see that across different cultures and generations of investors. I'm reminded of, I was just thinking about the greatest generation, as I said that, and the challenges that they were confronted with. Tom Brokaw wrote the book, The Greatest Generation, and one of my favorite comparisons to that, I don't argue with that at all. I do think it was The Greatest Generation. But Andy Rooney, the old cantankerous 60 Minutes contributor, he wrote a book called My War. And in it, he argued with the concept of them being the greatest generation. And his point was that they were simply created or greeted with the biggest circumstances or the greatest set of circumstances to overcome and to match, and that other generations would have done the same based on just evolutionary thinking and all the things that we're talking about as well. And I think that really plays into this idea. So, culturally, where you're brought up, how you're brought up, and the influence of it. This is one area where I think the internet and that kind of shrinking of the world, if you will, that we're exposed to so much more, that we've got so much more information available to us. I think this is one of the areas that actually helps us is to overcome some of those cultural issues because we have more information available to us, and has helped us to really see a bigger picture when it comes to some of those issues. Not always, but some.
Sure. Well, and that maybe brings up a good segue, with the internet, and especially recently, this is a little after, still during some of this GameStop craziness. Another thing I want to spend a little time on is envy. That kind of fear of missing out, of FOMO, and
Sure.
Our neighbors getting these returns of some crazy stock or whatever it is. So hoping you can maybe talk about that a little bit too.
Yeah, again, those are some of the emotional extremes we're confronted with. Right? We always think fear and really bad, mean, nasty environments. It's logical. We get that those are overly emotional states where we might make bad decisions. But the truth is euphoria or greed is just as much a risk to us, in that we tend to make bad decisions because we see others getting rich at a time, or talking about getting rich at a time when maybe we're a little bit more conservative, or we just haven't taken the investment risk that they have. And some of those things pay off for them. I think that's where we have to have the emotional wherewithal to stick with the plan, and understand that one person's risk profile, what they're willing to and can easily handle. It comes back to, can we do that? Can we put ourselves in that scenario as well, and really always trigger or anchor ourselves back to what our eventual goals are? Because again, I go back to one of my earlier statements about it's not the cognitive ability to understand what is right. It is that emotional wherewithal, and really building it up in terms of not looking at others and seeing what they have, but trending on a path, on a line for our own retirement and our goals. And goals are unique to everybody. I think most people want to simply retire with dignity. They want to leave meaningful assets. They don't want to outlive their money. They want to have enough to live the lifestyle they want to in retirement. And the more they can keep those goals in mind, it's not about one day, 1 week, 1 month, 1 year of returns. It's the more frequent compounding at mid-single digit, low or high single digit compounding of returns with volatility you can actually live with in your portfolio, so that it doesn't force you to make a bad decision and go to the sideline when we see the frequency of pullbacks. When you look at the history of returns, both positive and negative, in the last 60 years, very rarely do we actually achieve exactly the 10% return average that we've seen. In fact, only less than 6 years out of the last 60 have we been within 2% of average in terms of returns. And more frequently, or at least as frequently, we've experienced negative 30% declines more than we have average declines intra-year, right? From peak to trough and within the given calendar year, including a minus 50% twice in the last 20 years. And so, we have to account for those factors. And I always talk about, achieving returns, but with volatility you can live with. For investor, and each investor, that's going to be different, and that goes back to the scenarios we can handle. And one of those scenarios we have to be able to handle, and the conditions we have to be, is missing a good opportunity, because it can cause us to jump in late and buy something at a very high price. You hear about all of the some of the more popular tech names that we've seen out there, certainly Tesla and Peloton and many of the others that have had outstanding results. They may or may not be right for your individual investment portfolio, but the fact of the matter is they become, the more you let emotion drive you, or that fear of somebody else has made a lot of money on this and I haven't, drive you to it. That's not a great decision-making foundation for why to own an investment, quite frankly.
That's great. That's super helpful.
Yeah.
Maybe one more question as we
Sure.
wrap up here a little bit. And I want to kind of switch this around. We've talked a lot about how markets can affect our emotions and upbringings.
Mm-hmm.
How about on the flip side, how do our emotions as investors affect the markets, if that makes sense?
Yeah, well, you see it in the outcomes of what we've talked about already. Herd mentality is another one of the biases that we have, right? That people, we tend to think together, and it can drive stock prices and irrational outcomes within market returns for very long periods of time. I think I mentioned earlier, Alan Greenspan's irrational exuberance. That's driven by market trends and the fact that everybody at the peak of the market in the late 90s, early 2000, technology and Y2K and all of those investment decisions and the influx of the internet and web applications and different sites, it drove the markets to much higher levels. And you can see that also as well in the credit crisis of 2008, where it continued to trickle and maybe led to some of the irrational heights of whether it be the housing bubble or different areas where we tend to herd together into these ideas. And that's a behavioral trait, right? That is based on the very thing we've been talking about for the last 25, 30 minutes already is how that emotion drives us to it. So you see people continue to plow in even at the tail end, whether it is a great sound idea or investment still, or whether the fundamentals have deteriorated to a point where it simply keeps going up with not much really fundamental driving it, but a lot of emotion driving it. Both market upturns and downturns can be driven by emotion and people's, like what you just said, fear of missing out. It's real and it's devastating in a lot of instances, and it's something we have to learn to deal with when it comes to managing behavioral traits and making good, sound financial decisions.
Sure. Yeah. So it sounds like maybe just exaggerating. I mean, the ups and downs are already going to be a part of any market, but exaggerating them even further potentially.
Yeah, absolutely. I think we see it over and over again.
Cool. Okay. Well, I think that's a good place to wrap up. Before we do, is there anything else that you may want to share? Or I think we've got through quite a bit, but.
No, I think that was great. I appreciate you having me on. It was a lot of fun, and appreciate the dialogue and the conversation.
Yeah, I really appreciate your time as well. And thank you guys all for joining us here today. If you do have any questions for us, you can email us info@mainsailfg.com. And thanks again, Paul, so much for joining us today. I think it's been great, and I think it's been really helpful for a lot of folks, hopefully.
Thanks, Brendan. Have a great afternoon, and appreciate your time.
Yeah, thanks a lot. You too.